Hello and welcome to this video brought to you by Passing Score, where you can ask any of your finance or accounting questions at PassingScoreForum.com. In this video, we'll be going over a basic but very common type of currency hedging scenario. In this case, we have a US company that's selling airplanes to a Japanese customer, and they have agreed to accept payment in terms of Japanese yen after 90 days. In this case, we have a transaction amount that's settled as of January 1st, so the payment will be made on March 31st. Now, what is Boeing, a US company doing business in US dollars, going to do with 1.2 billion in Japanese yen? Well, since Boeing is in the business of selling airplanes for a profit and not speculating on what future exchange rates are going to be, they may want to eliminate this exchange rate risk through the use of what's called a currency forward exchange rate contract. In this case, we have a 0.0083 yen per dollar 90-day forward exchange rate as of January 1st. And this means that they'll have a locked in dollar amount of $10 million on March 31st, eliminating their exchange rate risk as soon as they sell their airplanes. The alternative is that they can go with whatever the exchange rates might move to by March 31st. They may not know what the odds are. The amount can vary by several million dollars, and this amounts to speculating or gambling on what future exchange rates will be, which is not what Boeing necessarily wants to do. The basic steps are as follows. On January 1st, when they know how much yen they're going to receive and when they're going to receive it, they enter into a forward agreement to sell those yen that they're going to get in exchange for a set amount of dollars. On March 31st, they receive the yen from their customer, and at the same time, they sell those yen in exchange for the dollars that they want to run their business, and that eliminates their exchange rate risk. A more visual approach is as follows. On March 31st, the delivery occurs of 1.2 billion to Boeing, who sells those yen immediately per the terms of the forward contract that they entered into on January 1st. The other side of that contract is a large bank that's in the business of managing those types of market risks for their clients. And they're the ones who send the $10 million to Boeing. This provides Boeing a service at a minimal cost, eliminates their currency risk, but it does add something called counterparty risk. And this is the small risk that JP Morgan on the other, or whoever is on the other side of this contract, may not be able to fulfill their side of the bargain, not deliver their $10 million. And as we saw in the financial crisis and other times of stress, there is some chance that this could happen, however minimal we might think it is. But overall, this expands Boeing's market opportunities. They're able to sell to customers anywhere in the world, including those that may not be able to make payments directly to Boeing in US dollars because their business is primarily in another currency. Well, that's it for our first currency hedging video. If you have any questions, please feel free to email me at john@passingscorefinance.com. And thanks for listening.